Hey everybody, we are going to talk about Redfin and Zillow, which is the best deep value real estate stock for you right now. Both of them are beaten down significantly from the highs. Before we dive in, take a minute, check out the link you see on your screen, fool.com/Frankel. You get the top 10 stocks to buy right now from our sponsor, The Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So, Redfin and Zillow are both real estate technology companies. They're not necessarily competitors. They actually partner on a few different things. And they're kind of two really different businesses. Redfin is the discount brokerage, is their core business. They're really the only major brokerage that has ever wanted to really compete on price with the establishment. Pretty small company, a $730 million market cap business. It is not currently profitable, even on an adjusted basis. It's heading in that direction, but it's a pretty small company. Zillow, on the other hand, has a market cap, a little over $9 billion, even after its big pullback. It trades for about 31 times forward earnings. Its premier agent business is its core business. That's the services it sells to real estate agents, and that business is very profitable. Zillow is a profitable company. Their core business makes money. Um, so I'll go ahead and kick it to Tyler first. Let's start with Zillow. Tyler, what are your thoughts on Zillow right now?
Well, I'm very glad that they made the decision sooner than later to get out of the iBuying business, because as we've seen with all of the companies in the iBuying business that were trying to do it either in COVID or just post COVID, it was a disastrous decision and very, very bad capital allocation decisions were
And
made. So
those were all better than Zillow at it.
yeah, and the better ones still stunk. And somehow Zillow was like, wow, we're lousy at this. We should get out of it. So kudos to them for getting out of the business and focusing on the premier agent core. There's we can get into the dynamics of the real estate agent world where we just had this ruling that basically says, buyer and seller agent fees actually have to be negotiated and can't just be like lumped in together all at the same time. How much that's going to impact Zillow over the long term, we're not sure, but they are trying to build other components within its premier agent business to try to diversify away, find new ways to kind of monetize on the real estate business. You know, uh, you they partner with an iBuyer as a lead generation sort of thing, which makes way more sense because you just get a fee from a lead generation, which is kind of what it was the premier agent business was. And to me, that has always been the value that Zillow could actually provide is just being lead generation affiliate revenue, whether that be through agents, whether they start doing that by, selling leads to mortgage originators, selling it to title insurance underwriters, basically all of the steps and processes that you have to go through in the home buying process. You can just basically like build up a network of affiliates who compete on bids to, get qualified people through a Zillow app. That seems to make sense. Some of the things that they are doing don't necessarily line up with that. Um, and yes, it's profitable with a caveat, right? Because if you look at Zillow's business, they will say they're profitable mostly on an operating basis, but they have rather substantial stock-based compensation. Over the past 12 months, they issued $456 million worth of stock-based compensation. This is for a company that, has not been profitable when you include stock-based compensation for quite a few years now. Yes, you could say free cash flow positive because free cash flow technically backs out stock-based compensation. But, uh, we'll say it again, diluting shareholders through stock-based compensation is just as bad as taking a loss or taking a free cash flow now. It's basically, kicking profitability down or, taking profitability now to kick it down the road, or taking cash now, excuse me, instead of, trying to take it in the out years in terms of per share value. So, that I can't say I've ever been a fan of the amount of money that Zillow spends. And of the two companies, if we compare Redfin to Zillow, one of the things I would have to say I appreciate a little bit more is that when things started going sideways, like I said, they got rid of their iBuying business. They were a little bit quicker to start to kind of cut overhead, business expenses, things like that, to try to get a little bit more in line with what the market was, sort of providing to it. So just like, for example, in fiscal year 2019, the cost of revenues were 1.5 billion. Compare that to the most last 12 months, it was down to 452 million. So it gives you an idea of like how much they've been able to kind of make it a little bit more efficient, maybe a little bit more nimble than Redfin has been. And just to throw a little cherry on the top, I know that like it's a $9.3 billion company, but it also has almost $3 billion worth of cash. Not really sure what it's going to do with it. Maybe it's going to make another bad investment, but I wouldn't hold it against them. I think that's a very real possibility to happen again. But or they could actually do something very effective, like buy back stock, or try to get the business a little bit more aligned with things that are going to make it grow efficiently in this new dynamic that we have in the real estate market. I don't know if I have the answers. I think we've all been kind of like throwing ideas at the wall of how to make the real estate buying and selling experience better. And a lot of the ideas that we've had over the past few years, either through new businesses or things like that, have struggled to do it. And I don't know, maybe this legislation change might be the thing that might be the kick in the pants that will make somebody like Zillow emerge as a more comprehensive player in this market.
You're very correct in the sense that real estate has been very stubbornly hard to disrupt um, for a long time now. It I was on a show yesterday for Motley Fool, and a couple of us, someone brought up the fact that Zillow should buy movers. They should focus on acquiring movers, moving companies, and own that part of the house
Ugh.
because that's well. And the rationale is that that's the biggest pain point of moving is actually packing up your house and getting stuff from one point to another and things like that. And if you can loop that in and make it less of a consumer pain point, Zillow has enough cash to acquire something like the top 10 movers in the U.S. if they wanted to. Yeah, interesting. I'm not sold on their super app vision. Kind of like how I think is kind of something that you're saying too. The settlement you're referring to with the National Association of Realtors will affect the buyer's agent side of the transaction more, just because right now people know what they're paying their seller's agent. They don't know what they're paying their buyer's agent. If I go to sell my house, I have to sign a paper that says what I'm paying. If I hire a buyer's agent, the seller pays it. What do I care? So the fact that Zillow gets 48% of its revenue from the buy side of transactions scares me, and that's the biggest reason I sold. Well, I sold because of the poor execution with iBuying and all that, but that was really kind of the last straw for me. Is that when the settlement happened, I dug in and saw how much money Zillow makes from the buy side, and that really scared me. Um, as far as Redfin goes, I still own Redfin stock, so that should tell you which one I like better right now. But Redfin is they're the brokerage, and they're set up to at the very least, have a neutral outcome from the settlement, if not positive. They're already price competitive. They already charge half of what the typical broker does to sell a home. They are making the best out of a bad real estate market, finally focusing on efficiency. A few years late, you're right, Zillow pivoted toward cost cutting, efficiency, getting out of bad businesses quicker. It took Redfin a little longer to shut down its iBuying business, even though it was arguably better at it than Zillow. But they're still losing money. There's a long way to go. They need a good real estate market to be profitable. Bottom line, they're experimenting with a lot of different things. An agent compensation structure that rivals what even the mainstream agents are paying has allowed them to recruit a lot of agents in big markets recently, and that's only in a few markets so far. So that's very promising. They're making all the right moves, but the bottom line is, I think they're going to need a good real estate market, or at least one that's at like historically normalized levels before they're going to turn profitable. Any thoughts on
Yeah, my
Redfin?
one con- yeah my one contention with Redfin, and this is kind of We talked about it before, where it's like if for them to win, they need to take market share. I know the market's down for selling real estate, but you need to show that you're taking market share. That hasn't necessarily been the case. And the other thing, and maybe I'm being a little contradictory here, but if you know that you're in a severely declining market, and you need to, profitability is kind of the name of the game here. You can't just keep issuing stock, taking on debt to cover to paper over your losses. You'd think you'd start cutting expenses, cutting overhead, and management said they were going to do that, right? It was like I think it was a few quarters ago. Uh, the CEO Glenn Kelman talked about wanting to significantly reduce overhead, especially with some of its like partner agents or things like that, which should bring down commission costs. But look at it from an overhead expenses, and this is where things to me look not like, it doesn't seem to me like they're really taking it seriously, right? So in fiscal year 2021, they had $337 million worth of SG&A expenses. The last 12 months, it was 339, and its R&D expenses have gone up from 140 to 180, so $40 million extra in R&D expenses at a time when we should be kind of bean counting a little bit, and really trying to focus on efficiency. It just seems to me that for a business that is struggling with profitability as much as it is, and you said there are some profitable components of the business, it seems like to me there should have been more aggressive cuts at the less profitable businesses to try to figure out, like, if we can kind of tear it down and build it up from a new position. Can we actually make a profitable business out of this? And it hasn't really happened yet. Maybe it will. I hope it does. Or like you said, maybe some of its new profitable ventures will start to overtake that. But until they actually do, I don't know. It seems like Redfin's like an unserious company to me. They don't seem to be taking the gravity of the situation of, being efficient, trying to focus on profitability as much as they should. And it shows. I mean, this was a company that it went from, let's see, it went from having $600 million of book equity in 2020 to negative book equity. So they're basically like, in like housing parlances, they're underwater on their balance sheet. And so you think of things like that, and it looks like a business that is more distressed than Zillow at this point.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.